Now, there was no shortage of drama in the financial world this week as Federal Reserve Chairman Ben Bernanke faced some pretty sharp criticism on Capitol Hill, and the Bank of America announcing that it would repay $45 billion in government rescue funds. You remember that TARP? Well, Robert Pozen, he is the chairman of MFS Investment Management, and he's got some thoughts on all this. Robert, good to have you with us. Thanks so much for coming in.
Thanks for being back.
All right, so you watched the hearings for Federal Reserve Chairman Ben Bernanke. You say, okay, he's going to get confirmed, but are they going to put him through the ringer a little bit?
Yeah, I think this is a good political drama. They can show their constituents that they're really tough. Their constituents are upset about how many big banks were bailed out, and so they're going to put him through the ringer.
Why is that? I mean, is it the Federal Reserve job to make sure that the banks don't go bust? I mean, it seems as though in all of this back and forth, everyone keeps saying, well, we didn't have the authority. Well, no, we couldn't do it. We didn't have the Congress. What's going on? They just passing the buck around?
Yeah, I think the Federal Reserve has enough authority to deal with the short-term liquidity issues, but then it's stretched out by bailing out Bear Stearns, AIG, a number of these companies. And I think the real issue is if the Fed gets out of its traditional role as a monetary authority and starts getting involved in all these bailouts, is it losing its independence and is it jeopardizing its institutional position? And I think, unfortunately, that's true. I mean, when the federal government guaranteed $300 billion for Citigroup, the Fed took $220 billion. And I don't know if the Fed should be involved in these sorts of things, and you see that now in the hearings. And I think ultimately the most important thing for the Fed is to retain its political independence so it can raise rates when it has to. And by getting so involved in these controversial issues, I think there's a little erosion there.
Is it possible to put that genie back in the bottle, so to speak? I mean, because now you get to say, you know what, they're not going to raise rates until the economy really starts going because, of course, we got midterm elections coming up. Come on, that's real politics.
Yeah, I think that the Fed will be reticent to raise rates, but, it depends on the numbers. I think they're going to look closely at the numbers, and we have a group of people in Asia who are also looking at the numbers. So if inflation rears its ugly head, they may have to move faster than they wanted to.
You mean the creditors might be looking at those numbers, huh?
Yeah, the people who own all our treasuries, those people, that's what I mean. And then the other thing is, Bank of America paid back this $45 billion. The question is just, did we as taxpayers get enough? When we put $45 billion into Bank of America, at that time its market cap was less than $35 billion, and we only got about 6% of the upside. That's because we did it with preferred stock with only 15% of warrants, and that's really too small. If we're going to take the risk, as we did, if Bank of America had gone south, you and I and all the other taxpayers would own those losses. And so if it does well, we ought to own the gains. Every other preferred share investor like Warren Buffett gets warrants equal to 100% of the face value.
How does this happen? How does the taxpayer get the short end of the stick again?
Well, I don't know. I guess they wanted to make the deal attractive to all the banks, but I don't think that should be the objective. The objective should be to protect the share of the taxpayers. And we know some of these banks, AIG.
But I want to find out what you think about the AIG package that is currently in place.
Yeah. Well, I think the AIG package is too generous to AIG, and the most serious thing is what came out in the last week or so with the federal auditor's report. It's ironic that people get so upset about the $165 million that get paid in bonuses to AIG. Now we know for sure that $62 billion was paid out to Goldman Sachs, Barclays, the
counterparties, right?
Counterparties, the most sophisticated counterparties in the world, and it was 100 cents on a dollar. The Fed didn't even try to negotiate a discount, or maybe more precisely, it made half-hearted efforts and paid all these guys out 100 cents on a dollar. We know that counterparty risk is the essence of risk management, and these guys flubbed it, so they shouldn't get 100 cents on a dollar. They needed to take some sort of discount.
Maybe we have to create a new term, right? A counterparty no risk to all of this.